Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news that stresses are building in China and therefore on countries that trade with them. Firstly, we should note that it is a federal holiday in the US for Veterans Day, but Wall Street is open and down 1.2% in limited trading, but in a risk-off mood. Japanese machine tool orders fell 1.1% year-on-year in October after rising 2.9% in September. This is the first decline since November 2016 and is because orders from China have been weak. And these trends are worrying officials in Tokyo. Prime Minister Abe is calling for a new public works spending program to stimulate their economy as concerns heighten about the global risks. Shanghai equities market was up 1.2% yesterday and rises were across the board. In Shenzhen, their market rose 2.4%. And this is despite growing evidence that China may be in fact have a current account deficit in 2018, the first in 25 years. A large deficit in the first quarter has been offset somewhat by second quarter and now third quarter surpluses. But that still leaves a year-to-date deficit of about $12 billion and is not clear will be overcome in the fourth quarter. This is an event that will have significant implications for China and especially its currency. It is being driven by their internal reform processes to try and shift away from investment and export-led growth to consumption growth. And the demands to keep spending to keep the trade war impacts from becoming social destabilizers is a new reality for them. The implications for the rest of the world are equally important. China isn't about to become a detonation anytime soon, but the ascent of current account deficits brings that closer. And that may bring temporary currency support for the Chinese yuan. Such a move is being feared in Australia. The last time the Chinese let their currency relax, they lost almost $1 trillion in currency reserves. This is a very high-risk area that they're getting if they get it wrong. In the US, they're staring a new reality in the face there, that their massive debt will need massive interest servicing, especially if benchmark bond rates keep rising as their gross debt balloons. The US Treasury 10-year yield is still at 3.19%. Their 210 curve is now just below 26 basis points. The Aussie government 10-year is at 2.74%, that's down 1 basis point. The Chinese government 10-year is at 3.50, unchanged, while the New Zealand government 10-year is at 2.83%, that was up 1 basis point overnight. Gold is down yet again, now at $1,203 an ounce. That's a $6 drop overnight. US oil prices are marginally firmer today and now just under $61 a barrel. The Brent benchmark is now just over $71 a barrel. Interestingly, there is some speculation that Saudi Arabia may actually pull out of OPEC. If it did, that would upend oil markets. That said, it doesn't seem actually likely anytime soon, and Saudi Arabia is talking up the prospect of new cuts in production there. And the Kiwi dollar will start today at 67.3 US cents, a little changed from yesterday, and keeping pace with a rising greenback. On the cross rates, we're a little firmer at 93.5 Aussie cents and stronger at 59.8 euro cents. That puts the TWI up to 72.1. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.